Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Update, July 30th, 2026. This explainer presents a direct informational narration of the source document. Now we're diving straight into the July 30th market update, a day defined by massive tech rotations, margin calls, and some really surprising macroeconomic shifts. Let's get right into the numbers. Part 1, Market Rebound and Liquidity. So the July 30th NASDAQ rebound was, well, violent, and it was driven largely by the Federal Reserve deciding to hold interest rates steady. That move unleashed this massive wave of dollar liquidity right back into discounted tech stocks. But that sudden shift actually created a perfect storm for one really prominent AI fund. Their crisis kicked off in July with a brutal 40% portfolio drop. And because they were running on 4x leverage, 4 times leverage, a late market sell-off triggered a devastating margin call from JP Morgan. Ultimately, this forced a pre-market bailout block trade to Citadel, literally just to keep the firm afloat. The market reaction to all that was immediate. Micron, which was a heavy holding in that liquidated portfolio, surged 18.3% right after the event. So what's the takeaway here? There are two big lessons from the source text. First, leverage is a massive double-edged sword that can absolutely ensure total ruin during a downturn. And second, broad market indexes offer way more safety from targeted institutional selling than holding individual stocks. Okay, moving on to part 2, macro data and the Fed. Let's zoom out from the individual funds for a second and look at the broader macroeconomic data that's currently steering the Federal Reserve's observations and policy. The current economy is showing this really fascinating mix of resilience and slowdown. To put it in perspective, Q2 GDP growth dipped to 1.5%, which is down from Q1's 2.1%, mostly dragged down by net exports. But the American consumer is actually still spending, up a solid 3.2%. Add in some incredibly robust corporate capital expenditures, which were fueled entirely by AI investments, by the way, and you have an economic engine that just refuses to quit. But the absolutely crucial number right now is 3.7%. That's exactly where June's personal consumption expenditures dropped to on a year-over-year basis. And even more importantly, we saw a 0.1% month-over-month drop. Why does that matter so much? Well, it's the very first monthly decline we've seen since the 2020 pandemic outbreak. This cooling inflation was the exact green light the Fed needed to hold rates steady this week. Which brings us to part 3, VIX and volatility outlook. Beyond the domestic numbers, we really have to look at the market fear gauges and the geopolitical dynamics that are shifting overall inflation. Following the FOMC decision, the market's fear gauge, the VIX, dropped sharply from a level of 20 as short-term post-FOMC hedges were released. But there's a huge geopolitical angle to this cooling inflation too, and that's falling oil prices. This relief at the pump is largely tied to a rather fragile US-Iran agreement that's designed specifically to suppress prices and tame inflation ahead of upcoming political cycles. Next up is part 4, Apple and Amazon earnings. Let's look at exactly how the biggest players in the space fared in Q2 based on the transcribed data. Amazon posted some pretty wild numbers. We're talking $2.6 billion in revenue, but a staggering $62.6 billion in net income. Interestingly, that massive profit jump came largely from non-operating investment returns. They also set their Q3 guidance between $197 billion and $200 billion. And, even though some question the quality of the earnings given that heavy reliance on investment income, the broader market absolutely loved it, pushing the stock higher in after-hours trading. Apple delivered really strong results too, coming in with $194 billion in revenue and an earnings per share of 2.02. Yet their stock actually dropped post-market. Why is that? In a word, capital rotation. You see, funds had been parking their cash in Apple as a safe haven during the recent semiconductor sell-off. Now that those semis are rebounding, that capital is aggressively moving right out of Apple and rotating back into chips. Finally, we have part 5, Big Tech AI CapEx. To wrap things up, let's dive into the massive artificial intelligence capital expenditure commitments outlined specifically for Microsoft and Meta. During its earnings call, Microsoft made one thing crystal clear. Their 2026 capital expenditure forecast remains entirely unchanged. This unwavering commitment to infrastructure spending was exactly what the market needed to hear. It sent a massive signal that ecosystem demand for AI compute power is here to stay, which naturally provided a huge boost to smaller cloud providers and AI equities across the board. And we conclude with Meta, whose massive infrastructure spending is acting as a huge catalyst for the entire semiconductor sector. They've committed roughly $700 billion to future expenditures. That's split basically right down the middle: $349.3 billion for irrevocable contracts on servers and networks, and $347 billion for uncommenced leases. While this scale of spending definitely raises some valid questions about short-term return on investment, it essentially guarantees massive revenue for AI infrastructure companies. With big tech locking in the foundation of AI at this scale, it leaves us with one critical question: who will actually capture the ultimate value of this unprecedented spending spree over the next decade?